$57 trillion. That's how much worldwide debt has increased since the financial crisis in 2007. Here to discuss this with me today and the implications, a very special guest with decades of professional money management experience, Mr. Bill Hall, Managing Director of Plimsoll Mark Capital and a special contributor to Money and Markets. Bill, thanks for joining us once again.
Hey, Mike, thank you for having me. I'm glad to be here.
Well, Bill, we've experienced an explosion of worldwide debt in recent years, which is increasing at a much faster clip than global economic growth or earnings. But markets really don't seem to mind by it at all. I mean, we see right here in this first slide you have for us, most asset classes are performing very well this year.
That's right, Mike. I mean, when you look at this first slide, that gives you an indicator of where the markets are. And the markets have drifted up in the U.S. About 4%. That's the first number that we see on the slide. It tells you what the S&P 500 is up. And it also tells you that the 10-year Treasury is up a little bit. And that's the reason why the market is up. The reason why the market is up is because interest rates continue to fall.
Mm-hmm. And in this next slide, we take a very closer look at, or a close-up look, I should say, at the debt picture. Just how much debt has grown at the government level, at the corporate level, just across the board. It's staggering.
Well, that's right. I mean, you look at this slide, and I think you've seen this one before, Mike. And what it shows, not the detail of these slides are important. It's the directional aspects that they show us that are important. And directionally, what we see here is that debt has not been paid down since we had the big crisis in 2009. In fact, we have more debt today than we did then. It's just astonishing.
And yet, even though interest rates have fallen to extremely low levels, which you wouldn't expect with this kind of debt overhang, we see on this next slide, interest rates are at near record lows for all the Treasury bonds.
That's right. I mean, you look at the U.S. 10-year Treasury, which is the bellwether interest rate for global interest rates. The 10-year Treasury is the marker against which all other fixed income securities are priced. And we see here that we've had not only have we had a decline over the last 2 years, a dramatic decline. In fact, we've had a marginal decline from the beginning of the year. So we keep hearing about how the Fed may raise rates. We may have a rate increase on the horizon. If we do, it's going to be very small, and it's not really going to affect the 10-year Treasury. All the Fed can control is the front end of the curve. And quite frankly, I think the Fed would be crazy to raise rates when we have a slow growth economy.
And if you think interest rates are low here at home in the U.S., I mean, just look at where yields are in some of the European markets. It's astounding how low they are.
Well, that's what I want to. That's the big point that I want to make today. Is we think rates are low here in the U.S. and we think that there's a global debt problem which is causing slow economic growth. Look at what's going on in Europe. What they're doing is they're penalizing savers. We have negative interest rates. Let me say that again. Negative interest rates. You hardly ever see that in a developed country. And we're talking about some of the bigger economies in Europe have negative interest rates. And what they're doing is they're trying to force savers into the real economy by investing in real estate, investing in hard assets, and they're forcing money into the stock market by taking interest rates below zero.
Now, speaking of the stock market, another issue on investors' minds are earnings. We saw this past quarter, first quarter earnings for the S&P 500 were very, very low, barely non-existent. Is that a concern of yours going forward?
Well, yes, it is, Mike, and I don't want to be Dr. Gloom and Doom or the doctor of debt. What I'm saying here is the way out of this, the way out of the economic malaise that we're in, and the way that we can continue to support these lofty levels in the stock market is if we do indeed get earnings coming through. We need to have corporate earnings to come through. We need to have growth in the economy, and that's how we work our way out of this mess without having some sort of market catastrophe.
And there you have it, folks, the macro picture from Bill Hall, Managing Director of Plimsoll Mark Capital. Thanks for joining us, Bill. You'll have to come back soon. And for Money and Markets, I'm Mike Bernick. Thanks for watching and good investing.